South Africa's fourth largest bank by asset has announced some sterling results in the interim financial performance for 2022. Absa Group's headline earnings rose 30% to 10.6 billion rands for the period ending June 2022. The bank has more than doubled its payout for its half-year, joining industry peers who have benefited from rising interest rates. Earnings in the bank's retail and business banking unit grew by 34%, with customer loans growing by 9% and customer deposits increasing by another 10%. I caught up with Absa Group CFO Jason Quinn and asked him what has made the difference to the group's performance in the first half of the year.
As Absa, we've had a number of successful periods now since about 2018, when we totally refreshed our strategy or reset it after Barclays left. Of course, we also had to navigate COVID with the rest of the sector. As I sit here today, I think most of the calls that we've made were good ones. I think we've executed well and consistently against the strategy. So the results we see today are testimony to all of that effort over the last few years. We came into this year with some momentum. We had a very strong year last year. So we sit here today with, as you say, earnings up a third, return on equity well above cost of equity now. And Kulani, you'll remember years ago when COVID was happening, I was saying to people, the return on equity won't get above cost of equity till 2023 or 2024. So our earnings and our returns and our ratios are all actually today better than they were pre-COVID. So Absa has a lot of momentum behind it, sir.
Let's talk about the retail unit as well, the different units within the bank. How have they performed individually?
So I think it's fair to say that coming out of COVID last year, it wasn't just Absa's corporate and investment bank, but most corporate and investment banks in the sector probably led us out of the crisis from an earnings perspective. Financial markets last year were volatile, but there was a lot of good decision-making in our corporate and investment bank. Our corporate business is very strong. So last year, corporate and investment banking, very strong performance, but slower this half. But of course, the base was set last year. And I think they did well to hang on to that strong base. Corporate banking revenues, for instance, Kulani, transactional revenues, they're up 14%, so you can see the investments in digital paying off. Retail business banking, of course, now was their time to shine. Our insurance businesses in the prior years had heavy claims around COVID, like most life companies did around the world, and we built lots of reserves. We didn't have to repeat that in this half, which meant that our insurance part of retail business banking did exceptionally well in the half. But as for the rest, revenues came through strongly. Fees and commissions in retail banking up 7%. I was very pleased with that. That shows that the efforts we're making around client primacy are working. Mortgages did well. Loan growth in mortgages, almost 9%. Vehicles did very well with low double-digit loan growth. Personal loans were okay. So, and then if you look at South Africa versus our businesses outside South Africa, their earnings growth was similar. So that portfolio diversification was a very good story, both up about 30%. So the sort of businesses outside South Africa, our markets there are growing stronger than South Africa still. So we see GDP in South Africa, let's call it 2 and a bit percent. North of the border, it's 4.5%. So almost double the growth we see in South Africa from a market perspective. So we still see, diversification in Arrow as a very strong opportunity.
Your primary bank client base has slowed down a little bit, and these are people who are in the entry level of the market, and they are the ones who actually bank with the bank to get their salaries most primarily. What are the reasons behind that slowdown?
100%. So I think you want to always measure, let's call it customer primacy in a couple of ways. So you want to look at customer numbers. But you also want to I always look as the finance director as hard revenues. So I say to you, the net fees and commissions, the actual fees we earned in retail business banking up 7%. So that shows to me that the stabilization efforts that the leadership team put in place there, to gather new clients, to stop clients from leaving us, to give the clients value, have been working. And remember, last year we cut fees by 500 million rand, to make them more sustainable, and the like. So we see growth in parts of it. If you look at actual customer numbers, I would use the word stabilized in total. Retail affluent growing quite nicely, at 7%. If I look at SMEs, nice opportunity. We must also remember that at the lower end of the segments, many people are multi-banked, so it's sometimes difficult to figure out what the primacy really is. We can certainly see our strategies working, and I once again say probably stabilized Absa from about 2018 onwards, when we were losing customers quite dramatically entering that last cycle.
The growth of the personal loan advances back to pre-COVID levels, what does it mean for the first 6 months of the year? We saw an 8% increase. What does it mean for you as a group and for the clientele?
Absa has had very much a secured lending strategy. So if you look at the primacy we were able to gain in mortgages and vehicle and asset finance for the last number of years, that's been a very good story. And similarly on deposits, a very good story. Absa's market share in personal loans is quite low. It's about 11%. So although it was nice to see that 8% growth, I think there's still opportunity for Absa in the personal lending market. I think it's got less to do with risk appetite and more to do with customer fulfillment. So as we've been able to get more capability in our digital channels around personal lending, we've seen that growth start to emerge. So I think it's very much a strategic play. We've been comfortable with the sort of allocation of capital to personal loans versus secured lending, and I think there's growth opportunities in personal loans for those that have good sort of risk management capabilities.
What factors are going to positively influence or actually drag down economic performance that you can forecast in the next 6 months?
Look, I think our dividend today there was 6.50 Rand a share. That's the largest dividend that, in terms of ordinary shares, our organization's ever paid. That rewards shareholders. Look, there's forecast risk at this time, Kolani. The GDP is under pressure. Inflation spiking up. Interest rates are going up. There's a lot of base effects there. Interest rates are going up quite quickly, but we think the terminal rate is actually quite similar to what it was pre-COVID. So prime at 11%, although it's got to go up to there and people have to navigate that, it's not worrying us with respect to the interest rate environment. Inflation, I think there's lots of base effects. We forget how low interest rates went and how low oil prices and things like that went. So I think this is a normalization, in fact, of post-COVID economic environment. And I think Absa is well positioned. We've got capital, got liquidity, got a clear strategy. We've been executing well. So I think we've got the resilience of the balance sheet. We'd like to grow. If we can't grow into the capital we've got, we'll basically have to look at dividends or other means.